So the thing we've been waiting for, the CPI report was released today and we need to get into it. What is going on, traders? Taking a little break from my break in order to give you this breaking news. I didn't even plan that. Just a cipher right off the top of the head. But let's get right into it. So what happened with CPI? CPI came in at 2.5%. Now we're going to talk about what this means. What does this mean for the stock market? What does this mean for the Fed rate cuts? What does this mean for the bond market? What opportunities can we leverage here? Shout out to you guys that joined the live day trading session that I had during CPI. We day traded CPI live, was 3 for 3. Go back and watch that if you don't believe me. Let's get right into this. So the CPI came in at 2.5% year over year. Now this is crazy considering that we just came in at 2.9% last month when we were projected to come in at 3%. And conveniently, somehow, we are now down to 2.5%, which, surprise, surprise, you might have already figured, gives the Fed impetus to cut on September 18th because they already confirmed it. And this is the problem with the Fed actually telegraphing what they're going to do, because if they don't do it, then all hell will break loose. The markets will crash. You will likely see a shakeup in the bond market. You will likely see a shakeup in the employment market, etc. And we could really be tripped into a recession if the Fed doesn't do something that the market heavily expects it to do. So surprise, surprise, once again, the CPI, and we'll break down the honest quote unquote CPI report. But it came in at 2.5%, and now you were seeing the probability of a 25 basis point rate cut at 85%. Now, I initially thought that if it came in as expected, we might get a 50 basis point rate cut. This happened in 2007, and this happened in 2001. But the reason we may not get a 50 basis point rate cut, a couple of things. Remember, the Fed projected that they were going to cut rates during Jackson Hole in August, which wasn't an official Fed meeting, right? But they didn't tell us by how much. And a 50 basis point rate cut signals panic. If you look at my post on X, follow me on X and on Instagram for daily trading finance content for free, absolutely free. I release, in my opinion, really the best content there is as it relates to trading and finance. Also on Instagram, you can follow my travels a little more closely because I do post more personal stuff there than on YouTube. But if you look at this, in September 2007, September 18th, ironically, which is the same date as the Fed is going to cut next week, the Fed cut by 50 basis points. They did so in January 2001 as well. Both times, ironically, the market rallied 5% after the cut and then tanked by 57% in 07 and by 44% in 01. So definitely cutting by 50 basis points signals panic. And the Fed actually here has the benefit of not having told us how much they're going to cut by. And so if CPI magically came in at 2.4, 2.3, 2.2, then I think the Fed would do 50 basis points. But because they didn't actually telegraph how much they were going to cut, and because CPI didn't come in significantly lower than expected, I think it is going to be 25 basis points. Now, it is interesting to hear that the Fed officials saying they're already starting to panic, saying that they can't wait for inflation to hit 2% before cutting. This is right on the Fed's website. It's also on this story here on CNBC. Atlanta Fed President Bostic says officials can't wait for inflation to hit 2% before cutting. And here's why the Fed has never achieved a soft landing, because you are now seeing reports that US inflation may soon undershoot the Fed's 2% target. So I want you to stay with me here. What this means is deflation, right? Deflation is when the prices actually go down. Just because CPI was 2.9% last month and it's 2.5% this month, it doesn't mean prices are going down. It actually still means that prices are going up. It's just the rate of price increases is slowing. That's all it means. But it still means that prices right now are 2.5% higher than they were this same time last year. But deflation is when you actually have price cuts, right? Similar to what China is going through now, what Japan has really struggled with for decades. But why is the government and the Fed really scared about deflation. Well, deflation can throw us into a recession. It can affect GDP in a very negative way, etc. So you are starting to see this panic here where the Fed is obviously they don't want to cut too fast, because if you cut too fast, you risk inflation coming back. And if you cut too slow or you don't cut at all, then you actually risk deflation. So that is why we've never achieved a soft landing. See, what happens is by the time you get to a point where the Fed is considering rate cutting, this is after a prolonged period of high rates, right? And it is a lagging effect. It is a majorly lagging effect, high rates, right? It's almost like, you know, when you're in an old shower and the water's cold and you want to get it hot, so you turn on the hot and it's still like freezing. And then by the time it gets hot, automatically it's like too hot, right? Immediately it's too hot. And then you have to wind it back down. And then, you know, you wind it back down, then it gets too cold again. Those of you who've dealt with old showers know exactly what I'm talking about. But that is exactly what rate cuts and rate hikes are like, right? So by the time that they start cutting rates, it honestly is usually too late. And the rate at which they cut rates, there is no exact science there. Like I said, if they cut too fast, inflation creeps back. If they cut too slow, we then risk deflation and throwing our entire GDP off. So before we get into the plays, what is actually in the inflation report? Let's get down to the nitty gritty and see how cooked this report is. I actually still looking at this, don't know how the hell we got a 2.5% CPI. So if you look at food, right, it's 2.1%. If you look at food at home, which includes basically all your groceries, it's at 0.9%, although eggs seem to have risen by 28%, the price of eggs. Juice, 18%. Frankfurters, 11%. Dried bean, 6%. Anyway, you could see, you can pause this here and look at all these categories and the price increases for each category. I don't know how we got 0.9% for food at home. Food away from home is at 4%. And then you look at all items, less food and energy. You have insurance up 16%. You have all these other commodities here up tremendously. I don't know how we got 2.5%. The only thing that's down is energy. Right? Energy is down 4%. That's it. Now, what is also glaring on here is that rent is so stubborn. We keep hearing that rents are going down. Rents are still up 5%. Now, I just want to note that this is year over year pricing. So this is not month over month, but that's crazy, right? Still, from last year, rent is up 5%. It's so stubborn. But as I've been saying, if CPI comes in favorable, right, and 2.5% is so near the Fed's target of 2%, and the Fed cuts next week, we will likely see a short rally until both yield curves uninvert, which is what I'm monitoring like a hawk. So the 10-year, 2-year already uninverted, and the 10-year and 3-month is far from uninverting. So until that happens, then I think that the market will continue in somewhat of an uptrend, choppy range, etc. I don't think we will get a drop in the market significantly until that happens. Now, when is that going to happen? Well, obviously nobody knows, but historically I do have some data here. Here are the yield curve uninversions and how long it took us to get to a recession. You can see here, the last one was 175 days. The one before that was 280 days, then 84 days, then 287 days. So just based off this metric alone, it looks like we still have some time. Now, I put this in my stock market analysis from the trading floor. I did a whole write-up, a huge write-up. Obviously, if you're part of the Discord membership, then you have access to that. If you want access to all my insights, check the link in the description below. And I go live every single day and day trade with the crew like I did today on YouTube, but I do that in the Discord in-house. But if you look at this, you can see that in terms of seasonality, September is actually a pretty crappy month. 43% of the time it's green only. And October is the worst at 29%. Now, this is specifically in an election year. So this is very apt for the time period that we're in now. So we could get a green September. October is a tough one. We might, see some choppiness in October. It is the worst performing month during an election. And then obviously after the election, we tend to get rallies. In December, we tend to get a holiday rally as well. Now, those of you who laughed at my assertion last year that I started rotating into bonds, and I would get comments like, enjoy your 5%. This shows how much people do not understand bonds, right? Bonds can yield double-digit returns. As a matter of fact, look at this here. Here's the S&P's performance during recessionary periods. You can see here that during recessionary periods, the S&P's performance averages minus 17%, while bonds has double-digit returns. This is the only double-digit returns bonds offer historically are during recessionary periods, especially when the Fed is cutting, because the Fed cutting usually lowers yields. And this is why I've been buying TLT since the 80s. Now it has finally hit 100. I do think we will see a little bit of a pullback in TLT, but I continue to buy the pullbacks in TLT. And as we get closer to a recession, I'm looking to increase my bond exposure to about 40% of my portfolio. That is just a personal preference. Do what you like. I do think there's an opportunity on chip stocks like Nvidia, like Broadcom, to get back to all-time highs. The level of calls that we are seeing on both Broadcom and Nvidia are just insane. It is clearly big money pouring in. We had, as of the time of this recording, an 8% day on Nvidia just today. Broadcom had a similar insane rally as well, showcasing 7% just today. And lastly, as I said on X before CPI, I said that this right here is a bullish harami. It's the same pattern that we saw back in April. And when we see this on QQQ, it usually signals the bottom of the correction / pullback. And if CPI is favorable, I expect this to shoot up. Now, as of the time of this recording, that is actually bearing out. As you can see here, we had a plus 2% day on QQQ, and if PPI comes in favorable, and I think the Fed is going to cut 25 basis points, I think we have a chance to get back to at least 485 here. And lastly, I just want to point out that I think people make a huge mistake conflating a black swan for a recession, right? Every time I talk about a recession, someone says, well, but in 2007 we had the housing crisis. And in 2001, we had, .com valuations were insane. We don't have anything like that now. So you're insinuating that we don't really have any triggers for a black swan. Assuming, let's just take what you say is true, a black swan doesn't mean that there is no recession. You can have a shallow recession. You can have a technical recession. You can have a recession without a black swan. As a matter of fact, most recessions came without a black swan. So do not conflate black swans and recessions. We can have a recession, and I believe we will have a recession, even if we don't have a black swan, right? I don't know whether we will or we won't, but I know we will get a recession, and it could be a very shallow recession. Who knows? Anyway, hopefully that broke down CPI for you. If you want access to all of my trades, you want to trade live with me every single day, click the link in the description below, sign up, join us. I will see you there. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.